Alright, so as you guys know, the Ethereum Merge is done, and it does seem like everything went pretty well. As you can see by this article over here, Dogecoin is now the second largest proof of work coin after the Ethereum Merge. And while some people are probably going to be moving to the Bitcoin blockchain in order to mine over there and make a little bit of profit, it seems like a lot of people aren't going to be supporting the Ethereum proof of work's fork. So it looks like maybe Dogecoin is going to be the next best option for all of those miners to migrate over to. I don't know if that's going to be very long lasting or if they're going to move over there at all, because Dogecoin is possibly going to be moving to proof of stake here soon as well, and I'm going to be talking about that in another video probably coming up on Monday. But as you can see, as I said, we did have a buy the rumor sell the news event, and it looks like Ethereum did have a little bit of a retracement. Right here, it did bounce previously on August 28th at about where we're at right now, $1,436. And if we can actually find support here, then hopefully we will be breaking above this downward trending resistance line and indicated by this blue line right here. But if we do break down below this, then I guess we're going to probably go down to this price target for this downward wedge, which was at the bottom of the wedge at about $1,000. If we do go down there, though, I think we could be hopefully forming a double bottom. And then, like I said, I really don't think that Bitcoin is going to be making a lower low below about $17,000. And if that is the case, then hopefully Ethereum will actually realize that Bitcoin wants to go to the upside and it won't continue dipping. Speaking of Ethereum dipping and Bitcoin not dipping, right now we actually don't have Bitcoin dipping while Ethereum has been kind of going down today. This is a really good signal because this means that the whales aren't going to be selling, and pretty much everybody has seemingly been shaken out of the market that wants to sell their Bitcoin up until this point. And unless we get some really big shocking news, I think that probably this is the bottom, like I said. And while we might not be going straight up from here, I think we're probably going to be going sideways and catching a pretty strong floor here, and this is going to represent a really great opportunity to accumulate and get ready for the next bull market. I know we did have a significant decline over the last few days, but I still say that this is going sideways because we have been at this point that we are right now multiple times over the last few months, and really we've just been moving sideways in my opinion, because you got to expect there's going to be at least some volatility with cryptocurrency in general. With the Ethereum merge out of the way, I think that what we got to look forward to now is obviously the Fed meeting, and with everybody expecting them to do a 75 basis point hike and us getting that higher than expected CPI reading, hopefully their rate hike is actually going to be priced into the market, and we're not going to hopefully see a dip after that meeting unless they do something bigger like a whole percentage point or 100 basis point hike, which would definitely shock the market and probably send it down. As you can see, the Fed meeting is going to be happening on Wednesday, September 21st, and that is this coming up Wednesday. At 2 o'clock, we're going to be having the Fed interest rate decision, and then 30 minutes later, Jerome Powell is going to be speaking, and we're going to be looking for his forward guidance to see if he's thinking about possibly pausing those interest rate hikes. I do expect them to do a 75 basis point hike in that meeting, and if they do anything lower than that, then hopefully the market can have a little bit of a rebound. But if they do a 75 basis point hike, I think it'll probably go sideways, and anything higher than that, you already know what's up. It's going to go down. But I went ahead and made a little compilation of Jerome Powell's Cato Institute speech from about last week, I think it was like 8 days ago, and Milton Friedman's speech back in 1979. We're going to see how the current Fed is fighting history, and I think it's going to be pretty telling on what the Fed is probably going to be doing going forward from here. So we'll just watch this compilation, and I'll make comments as we go along.
Now, the first step toward understanding the cause of inflation is to recognize that it is always and everywhere a monetary phenomenon. It's always and everywhere a result of too much money, of a more rapid increase in the quantity of money than an output. Inflation in the United States is made in Washington and nowhere else.
I think it's really important that we pay attention to these historical revelations because we already went through all of this and learned these lessons in the past. We can't ignore history and go ahead and try to make up our own rules now because it's very important, and we don't want to repeat the past because obviously the 70s weren't very much fun.
This high inflation that we see around the world now would have happened without the pandemic. The pandemic severely disrupted the economy, gave rise to risks of much more dire economic consequences than actually transpired really. And that was thanks in part to the policy response.
He did say that it was thanks in part to the policy response, and that is kind of accepting responsibility for the fact that it is a monetary phenomenon, but he is kind of putting the blame off a little bit and saying that it wouldn't have happened if it wasn't for COVID.
The real tax on the American people is what government spends. If the federal government spends $450 billion and only raises $400 billion in taxes, who do you suppose who pays that other $50 billion? Do you suppose a tooth fairy does?
Since the beginning of the pandemic, we've printed more than half of all of the dollars in existence. And where do you think all of that money is going to come from? It obviously has to come in the form of inflation because they haven't raised our taxes and made us pay trillions of dollars worth of taxes yet. All of that has to come from somewhere, and there is always going to be an inflation if there is a massive increase in the quantity of money.
You pay it, and I pay it. And one of the ways we pay it is by the tax which we call inflation. Inflation is, from this point of view, a form of taxation. If government spends more than it takes in the form of things that are called taxes, it has to meet the difference, either by printing money or by borrowing from the public at large.
So, to start with policy, there's no question that policy certainly supported strong demand. But in my view, you would not have seen anything like the inflation that we have seen without the pandemic effects. And those pandemic effects include both shifts in demand and also playing a role in, not solely causing, but playing a role in the supply side constraints that emerged. So
really, I don't think I got to say anything because Milton's about to crush him.
There is no such thing as cost-push inflation, except in the form of the delayed effect of monetary inflation.
That's right. The demand that we saw over the pandemic was a result of the pandemic, but that demand would not have been fulfilled if they didn't pump all of the money into the economy. That would have caused a recession, and it would have been deeper than the one that we saw in that small flash crash that happened back in March of 2020. And it wouldn't have came up as quickly as it did, and it definitely would have caused some pain. But we wouldn't be going through all of this inflation right now, and it seems like our economy would probably be starting to come back and be pretty strong at this point. They just overdid the stimulation, and now we have way too much money going into the system, causing all of the shipments to be made to everybody's houses. People were ordering way too much stuff, and of course that caused oil to go up in price, and everything really goes back to the money. If you just follow the money, then you will see that none of this would have been possible if the Fed didn't continue printing money and Congress didn't continue with the fiscal stimulus and all of the stimulus that was sent directly to consumers.
If you have a monetary inflation that starts to push up prices, it tends to hit retail and wholesale prices first, the prices you and I pay. It's only later that it works its way through costs. But then costs fall behind prices, and there's a makeup period. And during that period, you have what looks like cost-push inflation. But there has never been an inflation in history that didn't respond to monetary restraint.
At this point, all of that money that was sent out to consumers and all of the stimulus that went into the system has made its way into the hands of the 1%. And now they're holding the economy and making it seem really strong, while the rest of us are all suffering. This is what happens whenever all of the money floods into the system. It's going to go into the hands of the people that are closest to the money printer, and the rest of us are going to suffer. The only way that they can stop that is to stop the money printer.
As for the pandemic, it did lead directly to an extraordinary shift in demand away from in-person services and to goods. And that shift, of course, was a major contributor to inflation in goods prices, which was really the main inflation story at the very beginning when inflation broke out suddenly in March of 2021. It's worth remembering that inflation actually declined in the early stage of the pandemic.
As you can see, he hasn't learned anything from history. He said that inflation just popped up suddenly out of nowhere, as if all of those trillions of dollars that were printed since 2020 just had no effect on the inflation that we're seeing today. This is absolutely delusional, and I believe that they're just lying to us and saying that this inflation isn't a monetary issue, because they're planning on probably turning the printer back on pretty soon, even with inflation being higher than their 2% target.
And then suddenly rose up in March of 21.
Of course. No government any more than any one of us likes to take responsibility for bad things. We're all of us human. If something bad happens, it wasn't our fault. And the government is the same way. So it doesn't accept responsibility for inflation. If you listen to people in Washington talk, they will tell you that inflation is produced by greedy businessmen.
Been hearing a lot of that from Elizabeth Warren.
Or it's produced by spendthrift consumers.
Been hearing a lot of that from pretty much a lot of politicians, including Elizabeth Warren as well.
But none of them produce inflation, for the very simple reason that neither the businessman, nor the trade union, nor the housewife has a printing press in their basement on which they can turn out those green pieces of paper we call money. Only Washington has that printing press, and therefore only Washington can produce inflation.
It's really just that simple. It seems like it would be more complicated than that, but everything does depend on the quantity of dollars in the system. It's called liquidity.
So to go to this current situation, so as part of our response to the pandemic, we did resort to large asset purchases to address what were pretty severe disruptions in markets, and then also to support the economy, and our balance sheet expanded dramatically.
Now, in saying that inflation is a printing press phenomenon, in saying that inflation is always caused by a more rapid increase in the quantity of money than an output, you're only at the beginning of the problem, because you must distinguish the immediate cause from the more ultimate cause. You must ask, why is it that the quantity of money increases too rapidly? But before I go on to that question, I just want to settle for once and for all the point that inflation is a monetary phenomenon.
That is not to say that money growth wasn't high. It was, of course, extraordinarily high in 2020, and then slowed down in 21, and now is quite sluggish. And I guess I would just say it this way. Whatever caused, there are different theories on what caused the inflation that so suddenly jumped up out of the ground in March of 2021.
Bro, he couldn't even say that with a straight face. He was like stumbling and looking down. He couldn't even look straight into the camera and say that. He knows that's a bold-faced lie.
There are fundamentally three reasons, in my opinion, why we have experienced inflation and why it is a threat. The first, and by far the most important, is in order to pay for government spending.
Obviously. And they continue to spend money. What do you think the Inflation Reduction Act is? That's such a stupid name. They should just put a P on the beginning of that and call it the Inflation Production Act, because this is absolutely retarded. What do they think is going to happen if they just print billions of dollars to stop inflation? That's just stimulating inflation. It's absolutely insane, and they just think that you're stupid, obviously.
Whatever that cause was, the relationship between the money supply and inflation, economic output, has been much more unstable than it was in Friedman's day for a very long time. And so literally changes in monetary aggregates have not had a consistent, reliable relationship. They haven't been a good predictor of the economy or of inflation.
So if he doesn't believe that it is like it was in Milton Friedman's day and that inflation is not a monetary issue, then what is their incentive to continue not printing money and continue quantitative tightening? I believe that this means that they are probably going to stop tightening here soon, and they're going to turn the money printers back on, because that's what they've done throughout history, and there's really no stopping it. It's just human nature.
We have evidence for the United States for over 100 years, for Great Britain for 200 years, for Sweden for 200 years. There has never in history been an inflation that was not accompanied by an extremely rapid increase in the quantity of money.
But somehow in the past 50 years, that's all changed, and now the Fed has total control over everything. It's absolutely ridiculous.
There has never in history been an extremely rapid increase in the quantity of money without an inflation.
But for now, and for really many years now, monetary aggregates don't play an important role in our formulation of policy. And we don't think they're generally a good way to think about policy or about inflation. It's more about demand and supply and things like that.
And so basically he's saying we haven't learned a thing.
So that's where we would be on that.
Right. Recently, we've heard that the inflation currently experienced in this country won't respond to monetary restraint because it's cost-push inflation and not demand pull. What response would you have to that analysis, if any?
It's another example of the people who produce the inflation trying to find scapegoats for their own deficiencies. Of course the inflation will respond to monetary restraint.
At the Fed, my position needs to be that fiscal policy really is the responsibility of Congress and the administration. Wouldn't be appropriate for me to comment too much on specific policy proposals or laws. More to the point, with inflation running so far above 2%, this is probably an especially good time to focus on achieving our own mandate rather than doling out advice to others.
So that's been always throughout history a major reason why you have had creation of money to finance government expenditures. But we've added another reason in these days, and that's allegedly to promote full employment. In the post-war world, after World War II, every country in the West has had a full employment policy.
The pandemic also contributed to constrained supply in a number of important ways, including a large and persistent reduction in the size of the labor force.
So in the beginning of this, the Fed continued to print money because the inflation rate was, while it was very much high, the unemployment rate was also higher than they wanted it to be at above 4%. So what happens whenever inflation continues to be high and then unemployment gets back up above 4%? Are they going to continue this tightening process, or do you think they're going to go back to what they were doing before whenever they were in the same situation and turn the money printer back on? Because as you know, the economy is definitely slowing down, and if you've watched my channel, then you know how I feel, and we're definitely in a recession and have been since the beginning of the year. So this is going to lead to the unemployment rate going up, and I don't really think that they're going to get inflation down before that happens. So what do you think is going to happen?
Which contributed to extremely tight labor market conditions and upward pressure on wages. Also, the turmoil in global supply chains was probably caused to some extent by pandemic-related shutdowns as well as strong demand, and particularly goods demand.
As we've been over, the reason that demand went up is because of all of the money that flooded into the system and trickled its way into the 1%'s pockets. Those are the people that have been having all of their wealth going up tremendously, and they've been having enough money to go spend in the rest of the economy. While a lot of small businesses have been crushed because of the decisions of the government, the 1% has continued to get richer, and while they continue to drive up prices, all of us are suffering, and the Fed just doesn't see it.
For quite a period, there was a threat of unemployment, or unemployment started to rise. There was a strong tendency by government to say, we've got to do something about this. We have to print more money. We have to spend more money. We have to stimulate the economy. The result of which has been to create an increased quantity of money that in the first instance has had some favorable effects on employment, but only temporarily, only so long as you could fool the people. And then, when people got on to what was going on, it came out in the form of inflation.
As it's happened over and over again throughout history for hundreds of years, it's happening exactly the same. It's almost as if he said that yesterday, but that man has been dead since long before the pandemic started.
We're created by Congress in statute, and Congress assigns our goals, and it has assigned maximum employment and price stability. It's my view that the dual mandate has served the public well and is generally workable. In particular, at the moment, I don't see the two goals as in conflict at all, because without price stability, we will not be able to achieve the kind of strong labor market that we want for a sustained period that benefits all. So,
like he said, at the moment he doesn't see them being in conflict, but as I said, I believe that the inflation rate is probably going to be staying higher than their 2% mandate as the unemployment continues to rise and gets back above 4%. The question is, are they going to say that their inflation target is now around 4 or 5%, Or are they going to be okay with the unemployment rate being over 4% and everybody demanding their jobs back and for them to do something?
Well, I don't see a case for moving to a single mandate, but that's really a question for Congress, and we will of course implement whatever mandate Congress gives us.
First, if you succeed in slowing down inflation, you will initially have some very difficult times. Just as inflating stimulates the economy temporarily, so slowing down inflation slows down the economy temporarily.
We think by our policy interventions, what we hope to achieve is a period of growth below trend, which will cause the labor market to get back into better balance, and then that will bring wages back down to levels that are more consistent with 2% inflation over time. That's what we're trying to achieve.
Now, I've already said that if you start to cure inflation, you will get some bad effects first. Let me emphasize that those bad effects are not themselves a cure. They are side effects of a cure. At the present time, the options open to this country are only bad options. We don't have good options. If you were sitting in at the Federal Reserve Board and deciding on monetary policy, you mustn't suppose you'd have anything good you could do. Whatever you do is bad. Given the amount that you have now of money that has now been pumped into the economy, you have only two bad choices. If you slow down drastically in order to try to hold back inflation, the economy will experience a recession, and it may be a fairly severe recession. Alternatively, you can say, well, we can't do that. We've got to step on the gas, keep doing what we're doing now. Then you are condemning the economy to going into another period of double-digit inflation.
That's exactly really the same thing that we're dealing with today. If they do continue to print money, then we're going to probably be seeing double-digit inflation. Right now, we're sitting at about 8.5% inflation supposedly, but I believe we're already probably in double-digit inflation, but it will definitely go higher if they continue to print. The thing that is different now than it was back in Milton Friedman's day is that the global debt is way, way higher now, and with US dollar going up against other currencies, it's making it a lot harder for other currencies to service their debts. That means that this is putting pressure on other currencies, and it's totally demolishing and crushing their economies. It's one thing for them to crush our economy, but if they do totally crush the rest of the global economy and it makes less sense to trade in dollars because they're worth so much more and harder to get your hands on, then maybe we're going to be losing our dominance as the global reserve currency, and I'm sure the Fed doesn't want that. So I believe that they are going to be stuck with a really tough decision here, and as Milton Friedman said way back in the day, there really is no good decision. They just have to make a decision and kind of go with it.
Around the world, many nations are experiencing the first high inflation in 40 years, all around the world. Different countries have different composition and backstories, but it's really quite global. And the question really is this going to be a temporary thing that's really related to the pandemic in some way, or is there actually something more structural and persistent happening?
Like persistent printing or structural printing throughout history? I wonder, maybe that's something that's going on.
What about international influences? The government is particularly fond of citing this to say, oh, well, you mustn't blame us for inflation. We've imported it from abroad.
As the Fed just said, that we have global inflation and that this is a global phenomenon. It's not their fault.
There's a worldwide inflation, and how can you expect the United States to stay clear of inflation if all the rest of the countries of the world are inflated? Now, that was a valid explanation before 1971, when we had a worldwide system of fixed exchange rates. In that case, it is true that inflation in one country would tend to spill over into another because it would influence the quantity of money. In that case, it was inflation in America that produced in the United States that produced inflation in many countries around the world because their currencies were linked through a fixed exchange rate with ours. But today, that explanation is not valid. As long as countries have variable, floating, flexible exchange rates between their currencies, inflation is a national phenomenon and not an international phenomenon.
There is a record of failed attempts to get inflation under control, which only raises the ultimate cost to society of getting under control, hence the need to do this job now and keep at it.
From 1929 to 1933, the quantity of money in the United States went down by a third. And that was a major factor that produced the catastrophe. That was a great mistake of the Federal Reserve. It learned from that mistake. Government agencies, like people, don't always make the same mistake the next time. They make a different one.
That's an interesting point right there. That is the one thing that kind of makes me think that the Fed could continue raising rates and totally crush the global economy. Because back in the 30s, we had a deflationary phenomenon from a lack of money, and that caused the Great Depression. And then in the 70s, we started to have really high inflation that was super hard to get under control. He just said that we tend to not make the same mistake right after the last mistake being the same one, and we'll usually go the other direction. So if we went from deflationary to inflationary in the 70s, maybe we're going to be going back to a deflationary set of bad decisions here from the Fed. To me, it's kind of a toss-up because I think really we've made both decisions in the past and they could make either decision going forward. But from the sounds of it, the Fed did say, or Jerome did say, that he doesn't believe that Fed is really a monetary phenomenon. He didn't say that word for word, but that's basically what he said. And that things are different now than they were in Milton Friedman's day. So in my opinion, that is kind of alluding to the point that he might be about to start raising or lowering interest rates again, or he might at least do a pause.
And since that period, the central banks have tended to make the mistake in the opposite direction. Their mistake has almost always been caused by confusing their function, by thinking that they had something to do with interest rates, instead of recognizing that their real function was to control the quantity of money.
So the Fed is a very special place.
They're special, all right. Another point that leads me to that conclusion is that in their last meeting in July 27th, they did say this.
We anticipate that ongoing increases in the target range for the federal funds rate will be appropriate. The pace of those increases will continue to depend on the incoming data and evolving outlook for the economy.
A lot of people really clung to that statement right there, and they were expecting that the Fed is probably going to be continuing to raise rates very aggressively into the future. And while I did say that I believe they're probably going to do another aggressive rate hike of probably about 75 basis points, I think that that might be the peak, and then they're probably going to be looking at the data, as they said, and they might be changing their minds coming up soon. Like I said, a lot of people really hung their hat and kind of just seemed like they tuned out after they heard that sentence right there, but they didn't listen to what he followed that up with.
We will continue to make our decisions meeting by meeting and communicate our thinking as clearly as possible. As the stance of monetary policy tightens further, it likely will become appropriate to slow the pace of increases while we assess how our cumulative policy adjustments are affecting the economy and inflation.
All right, so as he just said, and people apparently tuned out after that super hawkish statement right before, he did just say that they might have to slow down their rate hikes going forward after the next aggressive meeting. So that means that as I said, possibly we are going to be seeing another 75 basis point hike. And then as we are starting to see this recession data coming in and earnings are starting to slow down and FedEx is starting to have problems with less shipping and all kinds of recessionary indicators that have started to pop up, they're probably going to be at least slowing down and maybe even pausing while they reassess and then eventually start to cut rates again. Whenever they do pause, as they just alluded to, I believe that is going to be the indication and really probably the last chance to get into the market, as people realize that the Fed is going to be printing again and will probably be going up from there. This obviously is mostly just speculation and it's not confirmed yet by any means. If we see another really high CPI reading come in before their next meeting after this next 75 basis point expected meeting, then we could be seeing another higher rate hike and then we could be going down some more. but I really do believe that we probably have seen the bottom, and this next 75 basis point hike is probably already priced into the market, at least mostly. Let me know what you guys think in the comments. Does the Fed seem like they're getting ready to turn back on the money printer because they don't think that their printing money is having an effect on the inflation as they kind of alluded to? Or do you think that I'm just crazy and I'm grasping at straws and hoping that the market is about to recover? Either way, thank you guys so much for watching. I really look forward to seeing what you think in the comments. I hope you have a wonderful day. Thank you for hitting that like button, and I'll see you next time. Bye.